Hello, everyone. Chris Hobart here, your Wealthologist, breaking down the biggest and baddest financial economic stories in a way that hopefully makes sense to you. So today, we're going to talk about something that most economists and financial analysts and even investors, well, they just love to ignore. And I think it's the elephant in the room. So, what if I told you that slow economic growth, not stock market growth, but economic growth, isn't just some random mystery, and that the classic 60/40 investing model, well, it just didn't magically stop working? There's actually a bigger reason behind both of these problems, and, well, spoiler alert, it's not something that Wall Street or Washington really wants to talk about. All right, let's dive on in. So, what's a real reason behind slow economic growth? Well, for decades, economists have argued about why economic growth has slowed down since the 1970s. Now, some have said it's technology, others say it's inequality, and others just blame education. But what if they're all just missing the obvious? You see, the elephant in the room is the sheer size and growth of the federal government, specifically the amount of money it spends and redistributes. So I want to share with you some numbers to kind of show you what I'm talking about here. Back in 1965, non-defense government spending was 9.5% of GDP, gross domestic product. Now, by 73, it jumped to 12.5%. By 2007, 15.2%. By 2016, 17.5%. Now, what is it today? 20.4%. That means that the government is now taking more than twice what it did in the mid-1960s and redistributing that however it wants. Now, here's the kicker. This massive spending growth erodes the benefits of innovation and economic progress. So let's say that we invent a new technology that boosts productivity by 10%. Man, that's great, right? But if the government is siphoning off 20% of GDP, well, that gain is basically wiped out. It's like running full speed on a treadmill. You're working hard, but not actually getting anywhere, right? So if we really want to end this great stagnation and get back to 4% plus GDP growth, I got to tell you, I think the solution is simple. In some form or fashion, it's to cut the size of the government. Now, is that going to happen anytime soon? Is it happening right now? Probably not to the level that would actually have the type of impact that we're talking about here to really spur the growth. But let's at least admit that ignoring it's not going to solve the problem either. Now, let's talk specifically about why the concept of the 60/40 model fell apart. And I'd say this is another elephant in the room. The death of the 60/40 investment strategy has been known for a number of years. Prior to, 5-6 years ago, advisors swore by this 60/40 split, 60% stocks, 40% bonds, and it's supposed to be the perfect balance of growth and stability. But lately, it's been failing pretty hard. The question is, did it stop working because it was a flawed idea, or did something else break? Now, once again, this leads us back to, well, you guessed it, the government, more specifically, the Federal Reserve. Back in 2008, when the financial crisis hit, the Fed launched quantitative easing, or QE, and they introduced interest on excess reserves. It was called IOER. Now, these policies separated interest rates from the actual money supply, meaning banks stopped trading federal funds the way that they used to. Well, instead of real markets setting interest rates, the Fed, well, they started artificially controlling them. And for the 9 of the past 16 years, interest rates were kept near zero artificially. Now, that's a big deal. Now, why? Well, because interest rates are supposed to compensate investors for inflation, a return on top of that. But when rates are artificially held below inflation, bond yields become worthless. And since the 60/40 model relies on bonds providing stability, well, there was really no option than for it just to stop working. That wasn't a coincidence. The Fed did this to help fund massive government spending at artificially low rates. Now, here's the thing. It wasn't about helping the economy. It was about making sure Washington could keep borrowing cheap money. So the bottom line, the government broke the system. And unfortunately, as investors, we're paying the price. So what's the takeaway here? The economy isn't growing the way it should because the government keeps getting bigger and sucking up more resources. And the classic 60/40 investment model didn't just stop working, the Fed broke it by getting in there and manipulating interest rates to fund excessive spending. At the end of the day, big government is the common denominator in both of these problems. Now, until we acknowledge that, all debates about why the economy is slow or why investing feels harder, it's just noise. Now, I hope you found this breakdown helpful. I'd love for you to like this video, subscribe to the channel, and drop a comment below. What do you think is the biggest elephant in the room when it comes to the economy? All right, thanks for watching, and I'll see you next time on the Wealthologist Weekly.